Welcome to Finance Explained, your destination to unravel all the mysteries of the financial and economic maze. Inflation destroys your purchasing power, and all of us feel this crisis in our wallets. Inflation is a huge issue around the world. In the US, UK, and Europe, inflation has reached a 40-year high. So, what is inflation? In economics, inflation is an increase in the general price level of goods and services in an economy. When the general price level rises, each unit of currency buys fewer goods and services. Consequently, inflation corresponds to a reduction in the purchasing power of money. Why is inflation so high right now? The COVID-19 pandemic. Remember? We all went into lockdown multiple times across the world to fight COVID. This caused a lot of issues for the global supply chain. People were not able to work or provide services. So, since lifting lockdowns, demands returned with a bang. But at the same time, supply chains were still limited. Pent up demand. Consumers and businesses received free money from government support policies. When this made its way into the economy, we witnessed a huge increase in demand into the economy. Think about all the holidays we missed and had to make up for. The Russian invasion of Ukraine destabilized global markets of energy, like oil and gas prices, and agricultural goods. Many traded goods that were normally shipped from both Ukraine and Russia, especially agricultural goods, are just not in the market. So, the prices go up due to scarcity of supply. But what about corporate greed and price gouging? If you would ask companies, not their fault. How surprising. However, research published by the Economic Policy Institute shows that profit growth is a big driver of inflation. So, corporate greed is hitting our wallets during the time of uncertainty. What are the consequences of inflation? As mentioned earlier, inflation reduces the purchasing power. As prices rise, the same amount of money buys fewer goods and services. Inflation puts pressure on wages and incomes. While some employers may increase wages to keep up with rising prices, there can be a lag between wage adjustments and the increasing cost of living. If wages do not keep pace with inflation, workers may experience a decline in their real income. Inflation can erode the value of savings and fixed rate investments. If the ROI, that is, the return of investments, does not outpace inflation, the real value of savings diminishes over time. Investors need to consider inflation when determining their investment strategies to protect their purchasing power. Inflation can redistribute wealth within the society. Those who hold assets that appreciate with inflation, such as real estate or stocks, may benefit as the value of their assets increases. Inflation introduces uncertainty into the economy, making it challenging for individuals and businesses to plan. When inflation is high or unpredictable, it becomes harder to make long-term investment decisions or set prices for goods and services. Inflation can affect a country's international competitiveness. If inflation outpaces that of trading partners, the prices of domestically produced goods and services may rise relative to imports, leading to a decrease in exports and impact on the balance of trade. So, what can be done? The simple answer here is that the central bankers hold the keys. All eyes around the world are on Jeremy Powell of the Fed, Christine Lagarde of the ECB, and Andrew Bailey of the BOE. They have the instruments to respond to high inflation, that is, to increase interest rates. Over the last 12 months, central bankers have increased interest rates. But have they done enough? Not everybody thinks so. Hawkish members think there is more to do, and dovish members hope that the top has been reached. So what is the main purpose of high interest rates? It makes borrowing more expensive, and the intention is to slow down the economy and reduce inflation pressures. Slowing down the economy? Yes, you heard it correctly. Jeremy Powell doesn't want to say it out loud, but his main goal is to increase unemployment levels. So, will history repeat itself? That is the $1 million question. What about previous interest rate hikes? Remember Volcker, the most aggressive interest rate hiker in the US? When he assumed office at the US Federal Reserve, he raised interest rates aggressively. He was successful in reducing inflation. The Volcker Fed interest rate raises are often cited as an example of bold and decisive actions to bring inflation under control and restore stability to the economy. Why does all this matter? Inflation impacts your investment significantly. If you think you got a 5% ROI, but inflation is 9%, you are losing money in real terms. This is many times misunderstood. So hedging for inflation is important. Inflation hedging, in short, is an investment that has the potential to maintain or increase its value in periods of high inflation. So, basically, it protects your wealth. Some examples of hedges are real estate, commodities, and TIPS, that is, Treasury Inflation Protected Securities. I hope you enjoyed our video. Please subscribe and leave any questions you may have in the comments. If you want us to cover any specific topics, drop your suggestions below. Stay tuned for more!